I wanted to, if I could introduce this concept. Now, one of my clients called me to task yesterday.
Okay.
She said, okay, John, but so how do you do it? And I said, okay, hold on a second. And I actually felt like I was in my 10th grade algebra class. And this is what I wanted my list to remember, my members to remind me of, which I remembered just now. My 10th grade algebra teacher, and by the way, guys, I got an A in algebra. I'm not a smart person in math, but I managed to get an A. She was just a really good teacher, and it was her first year. She was like 22 or 24, and I remember in the first semester or whatever, she was so nervous. Anyways, she was like nervous. You could tell she was like her first year teaching.
Yeah.
But I remember it because her name was Fluck. It was Miss Fluck. Now you can imagine what 16, 17-year-old students did with that,
What? Yeah.
right? Did you do your fucking homework? Stuff like that. So, anyways, we got along just fine. But I got A's, and I had to because I was competing with my brother and whatever. So, anyways, so I felt like I was in her class and that she was sitting next to me laughing at me because I'm trying to remember a very simple algebraic function. So this client is telling me, how do I figure out what tax do I pay if she wanted to take out X dollars from her this outrageous windfall she just got already from cryptos. She had a small amount in there. Now it's this huge amount, and she wanted to take a little teeny tiny amount, which is really 5%. She wanted to take like 5% and do something on her house, like it was a home improvement. So that's
Yeah.
personal.
That's
But
exactly what we should be wanting to do.
okay, and now in her case, because of the nature of the transaction, it's very difficult to legitimately avoid a tax on that. And she was fine with that. So I said, well, here's how you would calculate it. So I'm going to give you the numbers. It was $20,000 out of $400,000. Now she started with like 23,500.
Good for her.
Yeah. So she wanted to take out her 20,000 and do whatever. The thing is, you have to back out your cost basis. So
Yeah.
how do you do that when, like, if she's going to spend the whole 400,000? Well, it doesn't take anyone who knows algebra to say, well, okay, just deduct the 23,500 that you started with, and then the balance is 376, whatever.
Sure.
But you have to come up with a way to reverse that and figure out on the percent that she's taking from the gain, what would be a gain. It's not yet a gain. The 20,000 is a gain. What percent does she need to deduct from that to deduct her cost basis? And so I'm gonna do the article. It's gonna be on Ace of Coins, but I'm gonna explain it to you guys.
Yeah.
Okay. So you just simply, I'm gonna read. I'm gonna have to read this. Okay. So
Sure.
I'm reading it from the article. To calculate reportable gross income after taking a small portion from the new principal, your original investment, okay, which is worth much more, for example, you subtract the product, multiplying together the product of the original investment and the amount you're taking divided by the new value of the principal. So you take like the $20,000 she's taken out, you divide it by the new principal and you get a ratio. In this case, it's 1/20th or 5%.
That's 380. So it's 20 divided by 380.
But we're taking the other part of that. We're taking the 5%, which is going to come out to be, well, we're not done yet. We have to multiply that by the amount she started with, which is 23,500. So take 5% of 23,500 and you'll end up with 1175.
Okay.
Okay, now that is the amount you back out of what is going to be taxable. So the 20,000 is taxable, but it's taxable 20,000 minus the 1175 gives you like 18,000 something, 800,
Right.
18,825, right?
Yep.
That is your gross income, reportable taxable out of the
Okay.
20,000 once you deduct your cost basis. You're not going to see that anywhere else. And how did I get that? I went and I on the phone with her. I did that on the fly, and then I went and researched to make sure I didn't screw up. And I think I got it right. If you guys want to correct me, I think I got it right. So, but anyways, if any of you is better at this than me, you probably are. Please tell me. But I think I got this right. So, um, if you want to test this out, you'll see the examples here. But basically, that's how you figure out the reportable taxable amount after you deduct your cost basis when you're not going to take out the full return. Now,
Yeah.
if you have if you have short-term, long-term, like in her case, it was a 5-year period where she invested $23,500 over 5 years.
Oops.
So she has short-term and long-term gains. So what you want to do is that equation I just described, you want to do it for the short-term gains number. So the money that you bought in during the short-term period, that's one equation. And the other amount is the long-term. So you have two equations. You do the same equation both times, and then you figure out your tax rate, and then that's your total. You add those together and you're done. Okay.
Okay. So she's still paying taxes.
In that case, she would. Now you can avoid that, but guys, I'm telling you, I can tell you how to avoid 100%, but you're
Right.
wasting your time. Pay the tax on personal stuff. Pay the tax on your living expenses. It's okay. Don't pay the tax on $10 million or $1 million, go put that. Here's your biggest risk. Trust me, your biggest risk is not having a way to reinvest the money that you, once you get your gains out of cryptos and you're like, okay, I'm done with cryptos for the most part. I need to get into something and be a responsible investor now because I'm
Yeah.
rich. Okay. What do? You would be stupid to go into the stock market. That's my premise on everything. If you guys call me on the phone and we're having a conversation, I'm always thinking in my mind, I am never going to tell my client to go in the stock market. Why? First of all, there's no market. Correct me if I'm wrong.
No, you're
There's no
right.
market. Okay. So there's a couple things you want to consider. Now, I'm going to have some videos on this, but we can talk more about it.
Yeah.
There are 4 types of investments you want to look into.
Okay.
It's private equity,
Yep.
which is maybe a share or a stock that's not on the stock market.
Right.
Same idea, not in the stock market. That means you sit down
Startup.
with your broker or agent or somebody, with the owner or his agent, and you negotiate a purchase of a share of his company.
Yeah.
Okay, that's a private equity. It doesn't always look like that, but just as an example. There's private equity, real assets, like things you see. You drive around town, you see supply chains, you see suppliers, you see FedEx, you see infrastructure. Okay, these are real assets. Real estate is another one. Real estate is probably, of the 2 things I recommend people get into to reallocate their, once they get their new windfall, is real estate's one of them. Unless you just really hate it, get into it. And there's many, many ways to do that. I'm not going to talk about that. And then
Okay.
another one is private credit, which again, I'm not really qualified to get into all that stuff. I'm going to have professionals on and we're going to talk about all that. But seriously consider a reallocation plan into other assets. And that is your biggest risk, not having that developed, not
Okay.
taxes.